HMRC has delivered yet another blow to your wealth. Capital gains tax rates have skyrocketed, and your annual allowance has been slashed to just £3,000. So let's fight back. I'm going to give you 12 proven ways to avoid capital gains tax, and these are all legal. So stick around to the end, where I'll reveal why leaving the UK, which you might be thinking, won't save you as much as you thought. Now let's break down exactly what HMRC has done with your money. First, they immediately jacked up the basic rate of capital gains tax from 10% to a staggering 18%. Now that's an 80% increase overnight. If you're making gains within the basic rate bracket, HMRC is now taking nearly twice as much of your profit. But of course, they haven't stopped there. The higher rate shot up from 20% to 24%. Now that's a 20% increase. That is anyone making substantial gains. Now these aren't small adjustments. These are wealth rates designed to fund government spending. And it's at yours at my expense. So let's circle back to your annual exemption. Your tax-free allowance has been absolutely decimated. It's now just £3,000. Now think about that for a moment, right? Because in 2022-23, you could make £12,300 in gains without paying a single penny in tax. Now, a measly £3,000. They've slashed your protection by 75%, while simultaneously increasing the rates you pay. Now this isn't a policy, it's a systematic wealth confiscation. The worst part is it's aimed at the wrong people. Most people won't even realize how badly they're being hammered. So here's something important you need to understand about how these rates work, because HMRC are certainly not going to explain it to you clearly. The bands apply across all your income. So if you're earning, let's say, $50,271 in salary, you've already used up your entire basic rate band. That means any capital gains you make on top of that, after that 3K allowance, is going to be hit at the high rates. That's 24%. So if you are a successful business owner or an investor, HMRC is essentially saying, we're going to take nearly a quarter of every pound of profit you make above £3,000. And surely most people would consider that not too short of daylight robbery. So let's start with strategies that anyone can use immediately. And as a heads up, you can download our CGT strategy guide in the comments section below. So first up, individual saving accounts, or ISAs as we all know them. You can contribute up to £20,000 per year into ISAs, and any gains or dividends are completely tax-free. You can buy stocks and shares within an ISA, and then when they grow, HMRC gets diddly squat, not a penny. You can also use interest-bearing cash ISAs for tax-free income. While HMRC is busy destroying a capital gains allowance, they've left the ISA system intact for now, so use every penny of that allowance while you can. Now, the UK government bonds, or the gilts, are also exempt from capital gains tax. Any profit you make is tax-free, though there may be income tax on the interest payment. Moving on, if you sell your main home, any profit is generally exempt from capital gains tax, primarily through residence relief. This only applies if it's been your main residence for the full ownership period. Now, HMRC might try and charge capital gains if you've rented it out or if you used it for business purposes. But if it's your primary home, it remains largely protected. So moving swiftly on to personal asset exemptions that most people may not know about. If you're selling personal possessions and the sale proceeds don't exceed £6,000 for an individual item, you don't need to calculate any gain. This is your proceeds exemption, so you need to use it. Another great one is the wasting asset exemption. A chattel is simply a tangible item you can touch and move, like furniture, antiques, paintings, even vehicles or pets. This is where it gets interesting, because a wasting asset has a predictable life of 50 years or less, and these are completely exempt from capital gains tax. Now, HMRC treats items like clocks, watches, boats, yachts, and machinery all as predictable life of 50 years. So it's making them a wasting asset. Moving on to family and charitable planning strategies. Gifts between spouses and civil partners are completely exempt from capital gains. So here's, let's say, how a smart couple would use it. If one of the spouses use their annual allowance or they're a higher rate taxpayer, they transfer the asset to their other spouse tax-free. Then they can sell it using their allowance and potentially paying lower rates. Now, HMRC can't touch transfers between spouses, so you can effectively double your planning opportunities within the family unit. You also don't pay CGT on assets given to charity, But do watch out, because if you sell to charity for more than you paid, but less than market value, you'll still pay the difference between, what you paid and what the charity actually pays you. That makes sense. When somebody dies, there's no capital gains tax on inherited assets. The deceased estate may pay inheritance tax, but you, the recipient, gets what's called a stepped up basis. This means that if someone bought shares, let's say for 10,000, then now they're worth 50,000. When they die and you inherit them, your cost basis becomes 50,000, not the original 10,000. So HMRC can't tax the growth that has happened prior to you actually inheriting. Now let's get into loss planning and business reliefs. Now, if you make a loss on an asset disposal, you can carry that loss forward indefinitely, even for 20 years if needed. So here's a smart play. You can use losses to reduce your gains down to exactly your annual allowance. So if you had 10,000 of gains and 7,000 of losses, you use exactly 7,000 to bring your taxable gain down to 3,000, i.e., your allowance. The remaining losses carry forward. Now, you're not wasting your allowance and you're not overusing your losses, but do watch out. You can't claim losses on sales to family members unless you're offsetting gains from the same person. Remember, you don't have to report losses immediately. You can claim them for up to 4 years after your disposed asset. So if you made a loss in 2021 and you forgot to claim it, you can still use it against your current gains. Now, that's important when it comes to things like crypto. Moving on to business asset disposal relief, it's formerly known as entrepreneur's relief. This doesn't eliminate capital gains, but it massively reduces them. When selling business assets or shares in your own company, you can qualify for reduced rates on up to 1 million of gains over your lifetime. So from April 2025, the rate rises from 10% to 14% and then up to 18% in April 2026. But even at 18%, that's still better than the standard rate of 24% higher rate CGT. Now, if you've built a business and qualify for the relief, you'll potentially be saving thousands compared to the standard rates. It's one of the few reliefs HMRC hasn't completely destroyed yet. Now, something you may have heard of is called rollover relief, but it is particularly controversial. If you sell a business asset and you use the proceeds to buy another business asset, you can defer the capital gains tax indefinitely instead of paying that tax immediately. Now, the gains roll on to your new asset, so you only pay, when you eventually sell without actually reinvesting. Now, it is particularly controversial because it's what wealthy investors and funds use to, buy farms and land, rolling those gains kind of forward indefinitely, while, let's say, real farmers get priced out of the market. Now, remember back at the start when I said HMRC are targeting the wrong people? Starting to make a bit more sense now. Let's have a look at investment schemes and alternatives. Venture capital schemes, which include your enterprise investment schemes. You've got seed enterprise investment schemes, and then you've got venture capital trusts. Now, these schemes give you both income tax relief of between 30 and 50% and complete capital gains tax exemption. If you hold for a qualifying period, it's usually between kind of 3 and 5 years, depending on the scheme. HMRC created these to encourage investment in smaller companies. So they're higher risk, but if you're comfortable with the risk, you can get a substantial tax relief while HMRC gets nothing from your gains. Now, talking of high risk, here is another high risk one, spread betting. This is basically speculation on market movements without ever owning the underlying asset. So if you made, let's say, 5,000 profit buying and selling shares normally, you'd pay capital gains tax. Make the same 5K through spread betting and HMRC can't touch it. Why? Because HMRC classes spread betting as gambling, and it pretty much is. It's not an investment. Since most gamblers do lose, they don't want to give tax relief on those losses, so they certainly can't tax the wins either. Now, here's some quick points on joint ownership and records. Now, if you jointly own an asset with someone else, you only pay CGT on the shares of your gain, not the whole amount. Now, here's something HMRC doesn't really make clear. Sometimes you can't use the actual sale price to calculate your gain. So for gifts, you use the market value of the date of the gift. If you sell something to help someone out for less than what it's worth, you use the market value, not what they actually paid. Now, for inherited assets, you use market value at the date of death. If you're, only selling part of an asset, like selling half of your shareholding in a company, there are special part disposal rules that can get complex quite quickly. So, ultimately, keep detailed records of everything. Purchase receipts, sales contracts, improvement costs, professional fees. HMRC will demand proof, and without proper records, they hit you with an estimated assessment, and it is always in their favor, never yours. Now, circling back around to what I said at the start about leaving the UK to avoid these punitive rates. If you leave the UK and become a non-resident, you still have to pay capital gains tax on any UK property. HMRC will want to chase you wherever you go for property gains. You don't pay capital gains on other UK assets like shares unless you return within 5 years. Now, if you come back within that 5 years, HMRC will retrospectively tax any gains you made whilst you were abroad. So if you're thinking of a quick tax exile, well, you have to think again, because HMRC have set up these rules specifically to trap people trying to escape these wealth rates. Now, there are special rules if you are non-domiciled and claim the remittent basis, but that's a whole other minefield that HMRC uses to catch the unwary. So those are 12 ways to protect your wealth from HMRC's capital gains tax assault. If you've got any questions on any of these strategies, drop them in the comments below and I'll help out where I can. If you found this video useful, explore our other videos to see other ways that we try and help you save on taxes.